The collapse of China isn't something far off. And we're not talking about some exaggerated prediction. We're talking about numbers, about signs, about a debt bomb that has already started leaking. For years, we were told that China was different, disciplined, solid, controlled. While the United States racks up eternal deficits, they supposedly save and plan for the long term. But what if that's just the image China wants us to have of them? Because while the world criticizes Washington's debt, Beijing has been quietly building a financial architecture far more fragile, far more opaque, and far more dangerous. Today, we're going to prove it. With data you won't see on television, with figures buried under layers of propaganda, and with an uncomfortable truth. China is more indebted than the United States. Much more. And the worst part? No one can say exactly how deep that debt goes. Stay until the end. Because when you finish this video, you'll understand this isn't an economics story. It's a countdown, and the clock is ticking. There's something no one is telling you about the world's most powerful economy. And no, we're not talking about the United States. We're talking about China. What you're about to discover could completely change the way you understand global stability, your investments, and even your financial future. Everyone talks about American debt. With over $38 trillion in gross debt, an annual fiscal deficit of $1.8 trillion, and a debt-to-GDP ratio of 124%, the situation worries even U.S. lawmakers themselves. And yes, America prints its own currency. The dollar is the world's reserve currency, and that gives it some room to maneuver. But that room isn't infinite. However, there's something that slips under the radar. Something far more insidious. Because while the headlines point to the U.S. as the reckless debtor, China has maintained the image of the prudent lender, the country that buys bonds, lends to the world, builds infrastructure, and seems to have everything under control. But what if all of that were just an accounting illusion? What if the world's biggest lender were actually the most indebted of all? The most conservative estimates suggest that if you add up the debt of the central government, local governments, state-owned enterprises, shadow banks, and the massive real estate bubble, China's total debt exceeds 300% of its GDP, and it could be much higher. This isn't just an interesting statistic, it's a silent bomb. And here comes the real question that changes everything. Who will collapse first? America or China? The United States is, without a doubt, the most indebted country on the planet, at least in nominal terms. With a gross national debt now exceeding $38 trillion, the federal government has crossed a line that once seemed unthinkable. To put that in perspective, that's more than $114,000 per citizen. And if that already sounds alarming, wait until you hear what's really going on. Current debt-to-GDP ratio exceeds 124%, meaning the federal government owes more than the entire U.S. economy produces in a year. That ratio has been climbing steadily since the 2008 crisis, accelerating through the pandemic and the massive spending that followed. Even more alarming, the fiscal deficit for 2025 is projected at $1.8 trillion. In other words, the country keeps spending far more than it brings in, and there's no sign that will change anytime soon. Now, many analysts say it doesn't matter. America can print its own money, and that's true. The US dollar is the world's reserve currency, meaning other countries need dollars to trade. This gives the US government a unique advantage. It can finance its deficits at reasonable rates because the world still trusts the dollar. But here's the problem. Debt isn't free. The cost of interest payments is exploding. In 2024 alone, servicing, that is, interest payments, became one of the largest expenses in the federal budget, even surpassing military spending. That money isn't going to infrastructure, healthcare, or education. It's going toward paying a bill that never gets smaller. The biggest threat here is confidence. As long as the world believes the US will honor its debt, investors will keep buying treasury bonds. But if that confidence breaks, if investors demand higher interest rates to take on the risk, then the cost of debt could become unsustainable very quickly. And this isn't some hypothetical scenario. In recent years, credit rating agencies like Fitch and Standard & Poor's have downgraded the US credit rating. It's no longer a perfect AAA. That means the world no longer sees the US government as infallible. And with every political showdown over the debt ceiling in Congress, that reputation erodes even more. So what is the US doing to fix it? Nothing. Absolutely nothing. Both political parties keep approving deficit budgets without real limits. Spending grows, tax revenues don't keep up, and no one wants to be the first to implement serious cuts, because that's political suicide. And what does this mean for you? It means America's debt is no longer just a gigantic number. It's a real risk. One that, if left unchecked, could lead to inflation, market crashes, higher taxes, and cuts to public services. Meanwhile, the government keeps borrowing more, as if nothing could ever go wrong. But remember this: empires don't collapse because of wars. They collapse because of debt. And this empire is already at the edge. China has built a reputation for economic strength. For decades, it's been seen as the great global lender, the one that hoards reserves, buys foreign debt, and builds infrastructure empires around the world. But behind that disciplined facade lies one of the most complex, opaque, and potentially dangerous debt structures on the planet. At first glance, China's official central government debt looks modest, around 88% of GDP, far below that of the United States or Japan. But that's just the surface. In China, debt is hidden in layers, spread across provincial governments, state-owned enterprises, shadow banks, and opaque financial vehicles that exist solely to borrow money off the official books. Even the most conservative estimates suggest that China's total debt exceeds 300% of GDP, and some experts claim it could reach as high as 450% if GDP figures were adjusted, figures that might be inflated by 20% to 60%. So how does a country reach this level of indebtedness without the world noticing? Because China's system doesn't work like Western systems. There, the state controls the banks, key companies, regulators, and media. That control allows it to mask risks, postpone defaults, and refinance debt indefinitely without showing outward signs of distress. For example, provincial governments have enormous incentives to take on debt. They finance mega projects, urban developments, and empty infrastructure projects, funded through loans from state-owned banks or local financing vehicles. These loans don't always appear as official public debt, but they exist, and they add up into the trillions. Then there's the weight of state-owned enterprises, SOEs. It's estimated that China has more than 390,000 state-owned companies, many of them heavily leveraged. These companies operate with political logic, not economic logic. They build, hire, and invest. Even when they don't generate profit, when they can't pay their debts, the state steps in, or worse, lets the hole grow deeper to avoid admitting the scale of the problem. And then come the shadow banks, entities that act like banks but aren't regulated as such. They offer high-risk credit outside the official system, massively increasing the country's financial exposure while leaving no visible trace. This hidden debt is not only enormous, it's invisible to traditional markets. International investors have no real access to the data, and many reports rely on figures filtered or manipulated by the Chinese government itself. So while China continues to appear as a trustworthy lender, the reality may be far more dangerous. It could be the most indebted country in the world, because its debt is not only immense, but no one knows where it ends. At this point, you might be asking yourself, if China is so indebted, why doesn't it look like it? Why do its bonds have such low yields? Why don't international markets punish its level of risk? The answer is simple, but unsettling, because China doesn't have a truly free market. In an open economy, when a country piles up too much debt, its credit rating drops and investors demand higher returns to compensate for the risk. That's what happens with emerging economies, or even with the United States when it approaches its debt ceiling. But in China, capital controls are extremely strict. Large investors, including banks, insurers, and funds, can't freely move their money out of the country. They can't buy US treasuries or diversify with foreign assets. They're forced to reinvest inside the system, and inside that system, the government calls the shots. The biggest banks are state-owned. Pension funds are controlled by the Communist Party. Insurers, sovereign wealth funds, even the financial media, all follow political directives. So, when the government issues debt, it doesn't need to persuade investors. It simply gives the order, and the system obeys. The result is a dangerous distortion. China can borrow at absurdly low rates, around 1.7%. on 10-year bonds, even though its risk is far higher than that of the United States, which pays over 4.5%. This is not a sign of strength. It's a sign of absolute control. In the short term, that keeps things stable. But in the long term, it's like putting a lid on a pressure cooker, because sooner or later, that pressure needs an escape. And the longer it's suppressed, the more violent the explosion will be. Unlike the United States, where household consumption makes up about 68% of GDP, In China, that number is barely 39%. That figure says it all. The Chinese economy isn't driven by its people, but by the state and its state-owned enterprises. In a country of over 1.4 billion people, such a low level of domestic consumption is alarming. It means growth isn't coming from a vibrant middle class, but from construction, debt, and public investment. And that creates a system heavily dependent on forced spending. Why don't Chinese citizens spend more? Partly because there's no real social safety net. Faced with uncertainty, people save aggressively. And since banks don't offer high returns and investment options are limited, most households have poured their savings into one single asset: housing. The result? The largest real estate bubble in the world. In cities like Beijing, the average home price can reach up to 35 times the average annual income. This isn't just investment, it's massive speculation. But here's the real problem. That bubble has been fueled by debt. Mortgages, developer loans, public investments in projects with no real demand, all funded by credit that, in many cases, will never be repaid. Meanwhile, the Chinese stock market offers no real alternative. Since 2000, the main index has risen less than 100%, while the US market has climbed over 300%. State control over companies and listings has turned the Chinese stock market into a place of political risk, not genuine growth. And what about innovation? Although China has made impressive technological advances, much of its industry still relies on imitation, subsidies, and state-directed projects. Independent startups struggle to survive without freedom or real access to capital. It's an economy that produces a lot, but consumes little and creates little lasting value. And that cannot be sustained forever. This imbalance has made China dangerously dependent on a single strategy: build more roads, more bridges, more buildings, even if no one uses them. And while that may boost short-term growth, it doesn't create real prosperity. There are no new consumers, no innovative companies, no strong private investment. At some point, construction stops being development and becomes disguise. Between 2000 and 2019, the United States tripled its M2 money supply, an enormous figure until you compare it with China. During the same period, China multiplied its money supply 16-fold. Yes, 16 times more money in circulation. That raises a brutal question. How is it possible that China printed so much money and still hasn't suffered hyperinflation? The answer lies in the unique structure of its economy. In China, the government has absolute control over the banking system. When it needs financing, it simply instructs state-owned banks to create credit. It doesn't need to turn to global markets or foreign investors. That money flows directly into infrastructure projects, state-owned enterprises, and local governments. And since nearly all of these players are politically aligned, the circuit closes without much resistance. But here's the trick. Inflation hasn't appeared because consumers don't spend. Money moves between institutions, projects, construction firms, and banks, but it never reaches the people's pockets. And if money doesn't circulate in the consumer market, prices don't rise. It's as if China had managed to trap inflation inside a closed financial circuit, fueled by a mix of financial repression, extreme saving, and stagnant consumption. But that doesn't mean there's no inflation. It's just not where we usually look for it. The real inflation is in the prices of unproductive assets: real estate, public debt, and corporate debt. Those are bubbles, growing quietly. And here's the real danger. When an asset bubble bursts, the impact isn't gradual. It's immediate, devastating, and nearly impossible to contain. China has built an economy where it can print money without visible consequences, but only for a while. Because inflation, like energy, never disappears. It only transforms. And when that transformation comes, it could turn into a crisis, sudden, violent, and global. Imagine this entire castle of debt, control, and illusion collapsing. What would happen if China's real estate bubble burst uncontrollably? If local governments could no longer pay their debts? If state-owned banks faced a silent solvency crisis? The impact wouldn't be local, it would be global. China is the world's second largest economy and the main trading partner of more than 120 countries. If its financial system starts to wobble, the shock will be felt from Berlin to São Paulo, from New York to Cape Town. Commodity prices would plummet as Chinese demand collapses. Global stock markets would panic. Emerging market currencies would sink against the dollar as investors flee toward safe assets. And that's just the beginning. The world's supply chains would be thrown into chaos. China doesn't just export finished products. It exports components, machinery, and key inputs. A Chinese financial meltdown would hit both manufacturers and consumers everywhere. To make matters worse, many countries owe money directly to Chinese banks or depend on Beijing-funded infrastructure projects. So the domino effect. For decades, the world bought into the story that China was the next empire, the nation proving that authoritarianism could be efficient, that planning could outperform freedom. A financial collapse would shatter that illusion. It would unleash domestic unrest, force painful reforms, or trigger mass repression. And in that atmosphere of crisis, the temptation to divert attention outward would grow. Tensions with Taiwan, the South China Sea, or even economic confrontation with the US could escalate rapidly, because when a great power collapses, the last thing it loses is its pride. And here's the most unsettling part. This scenario may be closer than we think. The symptoms are already there: slowing growth, runaway debt, weak consumption, invisible bubbles. It's no longer a question of if it will happen, but when. And when it does, no one will be spared. Because when the second engine of the global economy stalls, the rest of the world trembles. Financial markets react not just to money, but to fear. And if fear grips global investors, we'll see a massive flight of capital, a crisis of confidence, and a domino effect too large to contain. The Western powers won't be able to stand by and watch. They'll have to intervene, respond, and adapt. Because when China sneezes, the whole world braces for pneumonia. For years, we were sold the idea that China was invincible, an unstoppable growth machine, guided by long-term plans and iron discipline. But beneath the surface, the system is creaking, strained, and on the edge of a silent collapse. This isn't just about debt. It's about an economy that prints endlessly, that relies more on cement than on talent, that builds empty towers but can't generate real consumption. China isn't an unbreakable titan. It's a financial time bomb wrapped in political armor, and the most disturbing part, no one's ready for when it blows up. Not them, not us. This isn't a video about China. It's a warning. Because when giants start to stumble, everyone feels the tremor. So if you want to understand what's coming, how all this connects to your wallet, your country, and your future, subscribe now, because this is just getting started. And if what you saw today caught you off guard, hit that like button. Drop a comment about what you think of China's situation, and share this video with someone who still believes China's got everything under control. See you in the next one. This was brutal. And if you still don't see it, open your eyes.